Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson is going to give his regular insights into what's happening to our property markets around Australia, and we're going to talk about increasing consumer confidence, which is translating into increased finance approvals, which is in due course going to underpin the next stage of our property cycle. So if you want to keep up to date with what's happening in our property markets, subscribe to our YouTube channel and click the little bell icon so YouTube can tell you when we bring out our weekly videos. There's a palpable change in property sentiment. Earlier this year, there were all those dire predictions suggesting property values would plummet, but now most of the property pessimists have changed their minds. They've backtracked on their forecasts. Australia's survived coronavirus better than many countries, and despite falling into recession, and despite our rising unemployment, and not even to mention Melbourne's severe lockdowns, our property markets have remained resilient. More recently, Treasurer Josh Frydenberg announced he'd be loosening lending restrictions next year, and this would free up credit. Plus, there's been the budget, which is creating lots of jobs and increasing consumer confidence, and these are going to underpin our property markets. Now, this week, the ANZ Roy Morgan Consumer Confidence Index rose 2.1%, the most in 7 weeks. It's actually up 49% since hitting its lows in March. Of course, it's still below the long-term average, but consumer confidence is increasing. And at the same time, we're spending a lot more. We're spending our money, we're feeling more confident, especially online. Now, 3 factors are crucial for the budget's recovery plan and the improvement in our economy: jobs, business confidence, and consumer confidence. Australians have got to have confidence to spend, and if they do, business income will increase. Businesses must then embrace the incentives and hire workers, and if they do, it means fewer people are going to be out of work, and this lifts confidence again, and more people are going to spend. Obviously, the tax and the job incentives are designed to boost our economy, but this will only work if confidence exists. So the lift in confidence over the last weeks is encouraging. You see, if Australian consumers believe their finances are going to improve, they're likely to spend more. And this is going to flow through to our housing markets, as we're going to find out today from Dr. Andrew Wilson, Chief Economist of My Housing Market. Welcome, Andrew.
Thank you, Michael, and welcome to you too.
Now, the new Australian Bureau of Statistics data showed that home lending rose in August, despite the fact that Melbourne, the country's second largest property market's in lockdown. Lending is a leading indicator. It shows what's ahead for our property markets, so I'm interested in your thoughts on this. But first, let's have a look at what's happening to our housing markets. Andrew.
Thank you, Michael. Well, yes, let's, as usual, have a look at the week that was in property. So we start off, as usual, with our weekend auction market results. And another strong result for the Sydney market. And quite interestingly, those listing numbers are very high and well ahead of where they were at the same time last year. But another clearance rate well and truly in the mid-70s. So sellers would be pretty happy with the prospects of selling under the hammer every Saturday in Sydney with the consistency of those clearance rates. And as we've discussed, higher listing numbers do reflect online auctions. So we need to be a little circumspect when comparing it to the same period last year. Melbourne, a few more auctions at the weekend. That'll take some time to recover the auction energy in Melbourne, of course, because that's still restricted to some degree by the coronavirus lockdown provisions. Other capital city markets tracking quite nicely through spring. Listing numbers are higher, and clearance rates are very strong, particularly in Canberra, which has been a bit of a boom market post-shutdown, Michael. If we look at that trend for Sydney, as I said before, well and truly entrenched now in those middle 70s clearance rates. Not quite as strong as a year ago, but certainly a good market for sellers with those results. And we would expect to see upward pressure on prices as those 70% plus clearance rates continue. Last weekend, the Northwest, the Hills District in Sydney was the top performer with a very strong result there, over 80%. But northern suburbs in Sydney continue to do best, but overall most regions providing good results for sellers. Top price last weekend reported, Michael, was a beautiful unit in Point Piper, went for over 13 million. We are seeing more prestige sales in the Sydney market, and this may be a sign of a shift in that particular price range, which has been a little soft in recent years. Melbourne's clearance rates, we're still tracking clearance rates in Melbourne, even though auction numbers are low and those clearance rates are a little volatile. But another reasonable result, over 60%, but we must say from a very low number of auctions listed and reported. And we can see that the listing cycle just starting to look like it's lifting, well, has lifted off the bottom. And I would expect that to continue to rise as we move through the latter part of the year. Of course, highly dependent on restrictions easing, as the prospects are getting better for those easings of restrictions as well. New listings data. So we've seen some interesting trends in new listings, Michael. We saw a falling away of new listings data last week, but over this week so far, we've seen a very strong surge in new listings. I think that lower new listings data reflected school holidays in most of our capital cities, but we've seen a bounce back over the early part of this week. And we're now tracking very close to where we were in terms of new listings. And these are daily new listings on a week-to-week basis. We're now very close to where we were at the beginning of the year. But most interestingly, Michael, we can see that new listings are now tracking at around about the same level as the same time last year. We haven't really seen that for some time. So listing numbers are now around about where they were a year ago. So that gives us some more sense of confidence in the market moving forward. We can see that, as I said, that over the week ending October 11th, new listings fell. I think there was some holiday pause energy there. Pretty consistent amongst all the capital city there in terms of weakening new listings. But as I said, this week we've seen a strong rebound in new listing numbers. The relativity index, again, even though listings fell over the week, Melbourne was still, in terms of the number of new listings, well ahead of all of the other capital city markets. In fact, nearly 30% higher than Sydney recorded over the week ending October 11th in terms of new listings. So that Melbourne market is certainly on the comeback trail. You can see that a similar result to the week before. We can see sales just eased off a little bit in Sydney. Again, some holiday energy there. I think some seasonality that's pushed that down slightly, but new sales volumes are certainly quite reasonable, quite robust at the moment in Sydney. Melbourne, we saw actually again some more positive signs for the Melbourne market, with new sales actually picking up and increasing. Again, of course, from a low base, but new sales are on the rise in Melbourne, another reflection of the property market now responding to the easing of those coronavirus restrictions. And Brisbane, again, with some seasonality issues there, we saw a falling away of new sales over the week in Brisbane. We can see that new sales data in Melbourne bucked the trend with the other capital city markets over the week, up quite strongly by 22.1%, again, as I said, from a low base. And when we can see that relative position of Melbourne versus Sydney in particular, that's now starting to rise. But new sales numbers are still around 60% lower in Melbourne than they are in Sydney, but the trend is certainly upwards, and I would expect that to continue through to year's end. Of course, again, dependent on maintaining at least the current restriction environment in Melbourne, and of course, an improvement would also help to lift new property sales. We can see, if we look at the overall position, new listings in Melbourne fell by 8.9% over the week. New sales, however, were up. Total listings, properties for sale, down by 9.4%. And Melbourne versus Sydney's total listings, Melbourne's lower by 13.7%. So the economy, Michael, share market has actually had a nice rebound over the past week. I think that's a response to the budget at some degree, but we've now got the All Ordinaries at higher than the coronavirus shutdown trough in autumn, and certainly with a very strong upward trend at the moment. Australian dollar has also started to climb back. I think that we saw a downturn in the Australian dollar with speculation of an interest rate cut over October. Maybe that speculation was just a month too early, but the Australian dollar is certainly consolidating its position after that fall of a fortnight ago. Now, we had that, as you mentioned, Michael, the new homes data from the ABS released last week. This is the data for August, and this does validate what we know in terms of other measures of the housing market. And we've seen a strong rise in first home buyers, also seen an increase in investor lending over August, not as strong as first home buyer activity. And quite remarkably, as we continue to discuss, first home buyer numbers are now at the same level as investors. And on current trends, I think we'll see first home buyer value of loans increase above those for investors. But the real strength was owner occupiers, Michael, and we've now seen we saw a very strong surge in owner-occupier lending over August, continuing on from the previous months. And we've now got owner-occupier lending at record levels and certainly set to continue as well. So good news for the banks there. The monthly change seasonally adjusted. Western Australia had the biggest result for housing loans. New South Wales, the underperformers, but they're all up quite strongly, all the states. And if we look at so far this year, however, New South Wales is the best performer over the first 8 months of this year compared to the same period last year. And if we look at the first home buyer activity, South Australia's had the biggest improvement over the month. New South Wales basically was flat in terms of first home buyer lending, but very strong results everywhere there except for New South Wales. And if we look at investors versus owner occupiers, we can see that owner occupiers have had strong results across the board there, although investors in some of the smaller markets coming from a lower base also improved their position. New South Wales investor activity, however, was flat over the month. And we can see that we also had we look at lending for new building, Michael, and this of course is being supported by those government policies that are providing grants for new home construction. We saw a very big rise in the number of new loans for new house building. And we can see that Victoria was the epicenter of that increase over August in lending for new home building. So that's it for this week, Michael. Certainly more positive signs of the market going forward. And we really are well and truly in that spring selling season vibe, but we still have a lot of work to do in the Melbourne market at the moment.
They're great figures, Andrew, and I understand there is a bit of a lag. So they're loans that were taken out a while ago, but it's also what I call a leading indicator. It's going to explain that people have taken their loans and they're now going to do something with that, which is good.
Yeah.
If you think about it, 10 years ago, if you took $1 million loan, you'd be paying $75,000 interest. If you want to buy $1 million property today, you're only going to pay something around $25,000 interest. It's going to make it much easier for people to get into the property market, Andrew.
Well, that's right, Michael. And I think also we probably still have the prospect of an interest rate cut over November. If we remember back in history, it was always a popular date for interest rate movements from the Reserve Bank, the traditional Melbourne Cup interest rate move up or down. But maybe we'll bring back the interest rate cut in a couple of weeks' time. But that would be positive news. I think if there was a cut, it would only be 0.1%, perhaps from 0.25 where it stands now to 0.15. Of course, at the margin, that's not significant, but it will add to downward pressure on interest rates. It will put more money in mortgage holders' properties and, of course, improve housing affordability and generally just add to confidence. So I think that the signals have been there. Perhaps we were all a little premature with predicting it for October, and it may come in November, but it would certainly enhance what's happened in the budget. But there's no doubt that that lending data is very positive, Michael. And I think also the refinancing environment is also affected by these record low interest rates.
One of the other concerns some of the property pessimists have had is all those people who put their home loans and their mortgages on hold for a while. But the news from the bank seems to be that more and more of those are now getting into the position that they're starting to repay them, which means we're not going to fall off a cliff when all this ends.
Well, the cliff's the new mantra, the new chant, isn't it, for the doomsayers? We had the September cliff. Well, that's gone. Now we have the March cliff. Likely that will go too, and it'll be replaced by some other cliff. I think that the point that you make, Michael, is sound in the sense that the loans that have been put on hold, in terms of the bank's balance sheets, if the bank looks at that surge in new lending, that tends to offset any losses it would be making through holding onto those loans. So that's got to be a positive financial environment for the banks to see so much new business coming in to perhaps offset any of the sort of negative financial consequences of non-paying loans at the moment. But look, all this depends on, of course, the economy and jobs continuing to be created. And that's the real key to supporting those people with mortgages that might be under some financial stress at the moment. So I guess we need to await the next unemployment numbers, which will be coming out very shortly, Michael.
Well, as I started to say at the beginning of this show, confidence is coming back. It's showing in our property markets, it's showing in our finances, it's showing in our spending. So I look forward to catching up with you again next week to see how it all plays out in our real estate markets, Andrew.
Thank you very much, Michael.